used when applied when doing a corporate valuation. And the corporate valuation is the process of determining just the worth of a company. And also, we can also do what we call the valuation of securities. That's how do we value the company securities such as debentures, ordinary share, preference share. But in this case, first of all, we'll focus on the first three methods. That's the number one, that is the economic value added. We have the enterprise value or the EV. And number three, we also have what we call the free cash flows. So in this case, let me start with the first one, the EVA. And this one is simply the economic value added. And in this case, the economic value added actually uses what we call the residual wealth of the shareholders. And in this case, the EVA, the economic value added, is just simply the difference between the NOPAT and the return on capital employed. When you say about the NOPAT, this means is the net operating profit after tax. And for the net operating profit after tax, note that in this case, we are dealing with operating. So in this case, we'll not deduct the interest. So when you're getting the NOPAT, so what you'll do, you'll take just the profit after tax, then you add back all the provisions, or what we call the non-cash, non-operating expenses, and also you add back the interest. I repeat, when you're getting the net operating profit after tax, you take the profit after tax, you add back the interest, and then you add back all non-operating expenses or non-cash expenses. Also, when you're getting the return on capital employed, in this case, you just take the capital employed, you multiply by the cost of capital. That's all about what we call EVA. And EVA is mostly determined to determine whether either the division is adding or the destroying value. And for EVA, the higher the value, the better the company, and the lower the value, the lower or the performance. So in this case, we have the following steps which are followed. Steps forward. When you're getting EVA, this are the following steps forward. So number one, you need to determine the NOPAT. Determine the NOPAT. To determine the NOPAT, number two, you need to determine the amount of the capital employed. To get the capital employed, then number three, you have to determine the cost of capital. Cost of capital. And whenever you're not given the cost of capital, you can use WACC. And whenever you're not given the WACC, you can use the CAPM formula. The CAPM. And how do you use the WACC? So now the WACC is just weight of equity, cost of equity. You add the weight of the debt, cost of the debt, and it should be net of tax. And also when using the CAPM, to get the return of the security, this one will be used the same as the cost of equity. So in this case, to get the return of the security of the cost of equity, you take the risk-free rate, you add the expected return on the market, and then you raise risk-free rate, you multiply by the beta factor. So that was step number three. And then step number four, now you can get your NOPAT. I mean EVA. Step number four, now you can get the EVA. And we have said that EVA is the NOPAT. You raise the return on capital employed. So that's the introduction for economic value added. And economic value added, one of the advantages of the economic value added is that this method is easier to explain to managers. Also, another advantage is that economic value added uses the cash flows, not the profits. Also, another advantage is it is consistent. We are consistent with the shareholders' wealth. That means in this case, we'll be focusing on the net wealth of the company. So another disadvantage, now let's look at the disadvantages. One of the disadvantages of EVA can be complex. Mostly when the number of the transactions are too huge. So in that case, also when the number of transactions is too huge, that means when adjusting for NOPAT, it becomes complex. So now let's do the first illustration. We do the first illustration on EVA. Illustration one. Illustration one. Illustration 1. Illustration 1. So for those with the handout, so kindly you can log in at page handout page 33. For those who downloaded from the Somia Kenya, that's I think page 1. Eh? So and that's the question, the first question, as you can see it there. Yeah. So in that case, you are told that we're doing illustration number 1 from the handout, and it's posted there. You can see it. So in this case, you are told that JM Limited has 2 divisions. That's J and M, which are managed by 2 different managers. Data from the 2 divisions are as follows. So you have both divisions, that's for J and M. You are given the net, the total assets. Then you are given the revenue, and then you are given the expenses. The minimum rate of return of the investment is 12.5%. So now that one, you use it as the cost of capital, and the corporate tax rate is that 5%. Expenses include interest payable on 10% venture worth 50,000 in J, and and interest payable on 11% loan worth 10,000 in M. Remember, you have said that when you are getting the NOPAT, number 1, you have to add back the interest. So in this case, you are told that, first of all, let's get the interest. We have division J and we have M, and you are told that the expenses include the interest. So number 1, you have to eliminate the expenses. So for J, it is 10% on debenture, which was 50,000. So, and that one you get is 5,000. Also in M, the interest rate was 11%. So you take 11%, and the loan was worth 10,000. So in this case, you'll get it's 1,100. Then you are told that the company uses EVA to measure performance of the managers required. Compute EVA for each division. So how do we compute EVA? So in this case, this is how we get the EVA. We have division J, and then we have M. You take the revenue. You are given revenue for J at a revenue of 107,000. Then for M, you had a revenue of 90,000. Then you also have the expenses. Now, for the expenses, you have to write the net of interest. Eh? So, for example, for J, we had 87. So you take 87, and then you eliminate the interest of 5,000. So that means if you take 87, you raise the interest. So that means the operating expenses, in this case, will be 82. Also for M, the operating expenses was 70,000. So in this case, you will take 70,000. You eliminate the interest of 1,100. So 1.1. So, and in this case, you'll get it 68,900. So after that, now you can get the earning before interest and tax. So if you take 107 minus 82, so that one will get 25,000. For M, it'll get 21,100. Now you can deduct the tax, and the tax rate was that 5%. If you take that 5% of 25,000, so how much do you get? So in this case, you'll get 8750. And on the other side, you'll get 7385. So in that case, now you can get the net operating profit after tax. That's the NOPAT. So in this case, you get 16,250. And for the other one, you get 13,715. So now let's get the EVA for J division and then for M. So in this case, we have said that to get the EVA, you take the NOPAT. In this case, you take 16,250. And for M, you take 13,715. Then you raise the return on capital employed. We are told that from the question that the minimum rate of return on the interest is 12.5%. So in this case, you take 12.5%, 12.5%, you multiply with the capital employed. So in this case, you're not given the capital, but you're given the total assets. So you take the total asset, 100,000, and for M, it was 80,000. So that means from the J division, the economic value added is that 750, and also for according to for M, you'll get that 715. And that's the economic value added. So in this case, we can say when you're taught to evaluate the performance of the two divisions, both for the manager of division J and division M, you can see this one is that 750. The two companies are doing great, or the two divisions are doing great. But in this case, J is doing more better as compared to M. So any question before I go for the next illustration? Any question? Jen?
Yes.
Jen Wakush, do you have any question?
Yeah. No.
Ask the question.
I don't have a question.
Sorry? Oh, you don't have a question,
have a question. Yes.
So I think now we can go for the next. Let's do another illustration. Sorry. Philip?
You're a bit too fast, sir.
Sorry?
You're a bit too fast.
I'm being so fast, eh?
Yeah.
So number one, first of all, don't copy, eh?
Yeah, okay.
Don't copy. First of all, and then I'll give you time to copy, eh?
Okay.
Another comment? Millicent?
Yes.
A comment or a question?
A comment. Should we write as you explain?
No. You already have the notes, eh? So for those who are at KC College, I have already sent the notes. For the others who joined using Somia Kenya, we have already sent the link, eh? So you can get all the notes, everything that we are going to cover today, eh? You can get it. Eh?
Okay.
Yeah. So I think we can go for the next question. Now let's look at the next question. And in case you have a question, so kindly you can click on raise your hand, eh? In case you have a question. So kindly click on raise your hand. So now let's do another illustration. Take out your past paper. Take out your past paper. Past paper. Past paper. That's November 2017. November 2017. Question 4. November 2017, question 4. November 2015. November 2015, question 4. Hoping you're all there now. As we start with question 4, we'll come back later to that. So you are told that define the term free cash flow. So that one, our next method. I'd also explain how the free cash flow can be, that one will come to it. Then number B, we have discussed 2 advantages and 2 disadvantages of economic value added. We say that one of the advantages of economic value added, this method is easier to compute and hence to explain to the managers. Another advantages, remember we said that even is good or it's consistent with the objective of maximizing shareholders' wealth, as well as EVA uses cash flows, not the profits. One of the disadvantages, remember, is that EVA can be complex, mostly when the number of the transactions are too huge. Eh? So now let's go to part C. That's our target. Part C. And the following information related to Joshua Limited. Statement of profit or loss is started extract for the year we're given there. For both the year 2013 and 2014, that's the income statement. Also, you are given the statement of financial position extract for the year. We have both 2013 and 2014. Now let's go to the additional information. Number 1, Joshua Limited had an uncapitalized lease valued shillings 10 million in each for year 2013 and 2014. 2013 and 2014. So an uncapitalized lease. You see, in this case, they never capitalized. So that one will add back to the value of the capital. Then number 2, the capital employed as per the year 2012, financial statement was 223. Then number 3, the pre-tax cost of the debt was estimated to be 9% in year 2013, and 10% in year 2014. Also, you are told that Joshua Limited, that's number 4, Limited cost of equity was estimated to be 15% in year 2013 and 17% in year 2014. Number 5, the pre-tax accounting profit is obtained after deducting economic depreciation. Now, economic depreciation is more of what we call capital allowances of the company than current asset. This is also the depreciation used for tax purposes. So that means the normal depreciation as a provision, and also you're given the economic depreciation. We have said that economic depreciation is more of capital allowances, which is an allowable expense. But for normal depreciation, that one is a disallowable expense. It's just a provision. Then you are told that number 6, the target capital structure of the Joshua Limited is 60% equity and 40% debt. So those are the weights. And now the effective tax rate is 30% in both the year 2013 and 2014. Economic depreciation was 30 in the year 2013 and 35 million in year 2014. Then other non-cash expenses were 10 million per year in both 2013 and 2014. Now for the non-cash expenses, you need to add back them to the net operating profit after tax. Then you are told that interest expense was 4 million in the year 2013 and shillings 6 million in the year 2014 required. Stating any assumption made, estimate the economic value added. How do we get even? Number 1, we have said that to get the economic value added is the difference between the no part, that's the net operating profit of tax, and the return on capital employed. So in this case, we have 2 years. We have here, or before that, first of all, let's get the cost of capital. For you to get the return of the capital employed, you need to be having the cost of capital. We have said that cost of capital in this case, you use WACC. And how do we get WACC? It's the weight of equity, cost of equity, weight of the debt, cost of the debt, 1 minus the tax. So now let's get the weight. Let's get the weight. So we have WACC. We get WACC for 2013 and also WACC for 2014. So now how do we get the weight? Now let's go to additional information, note number 6. Number 6, additional information number 6. Get it to be 15%. Number 4, Joshua Limited cost of equity was estimated to be 15% in year 2013 and 17% in year 2014. So the cost of equity for 2013, that one we are told it was 15%, and for year 2014, it was 17%. And then you add weight of equity, cost of weight of the debt, cost of the debt. Now let's go back to note number 6. Note number 6. We are told that the capital structure of Joshua Limited is 60% equity and 40% debt. Now the weight of the debt is 0.4, 0.4. You multiply by the cost of the debt. Let's go to note number 3. Note number 3. The pre-tax cost of the debt was estimated to be 9% in year 2013 and 10% in year 2014. So this was 9%, this was 10%, and then you deduct the tax. We are told that the tax rate was 30%. So 1 minus t, so that one becomes 0.7, 0.7. And in that case, how much do you get? So in this case, you'll get 11.52%, and the other one you'll get 13%. Any question up to that point? Any question? Ask a question in case you have a question up to this point. In case you have a question, raise your hand. So now let's continue then. So now let's determine the EVA. In this case, we have year 2013. 2013, 2014. So we have said that to get the EVA, you take the no part. So you take profit after tax, profit after tax, profit after tax. For 2013, it was 44. This one was 45. That was the profit after tax. Then let's go back to note number 10. Note number 10. Note number 10. Interest expense was 4 million in year 2013 and 6 million in 2014. You see, the interest expense is not an operating expense. So that means you add back because you are getting the net operating profit after tax. So you add the interest. And in this case, it was 4. And the other one was, it was 6. Let's go to note number 9. Note number 9. Other non-cash expenses were 10 million per year in both 2013 and 2014. The non-cash expenses, so that means they were not operating. So that means you add back the non-cash. And you are told that there were 10 million per year. So it's 10. Get 10. So that means you are no part. So this one, 44, that's 54. That one you get 58. Also for 2014, how much do you get? How much do you get? What do you get for 2014? Sorry? No, you're adding back. You're adding back.
5 plus 16.
That
is 61.
So this one you get 61. No, but in this case, the interest should be the net of tax. Remember, tax is an allowable. Remember, interest is an allowable expense. So that means for year 2013, the interest expense was 4 times 0.7 should be net of tax. So how much do you get? 4. Are you getting 2.8?
2.8.
Also for 2014, it was 6. So it's 6. It should be net of tax times 0.7. 4.2. Yeah, it's 4.2. So that means our no part will change. So that means our net operating profit after tax, this one will be 58. 56.8. And this one will be 59.2. So that's the no part. Then we deduct the return on capital employed. How do we get the capital employed? So for the capital employed, in this case, you need to be very keen. For year 2013, you have to use the capital employed for 2013. Now, remember the closing capital for 2012 becomes the opening for 2013. And the working capital for 2013 becomes the opening for 2014. So in that case, let's go back to additional information. Note number 2. Note number 2. Note number 2. The capital employed as per the year 2012 financial statement was 223. So for 2013, I repeat again, you use the capital employed for 2012 because the closing working capital, the capital employed for 2012 becomes the opening for 2013. So in this case, you have 223. And then the capital for 2013 becomes the capital employed at the beginning of 2014. How much was it? Let's go back to the financial statement. The statement of financial position, the statement of financial position. For 2013, can you see 250? Eh? That's either the total assets or the finance by, that's the capital. Eh? It was 250. So the capital for 2013 becomes the opening for 2014. Now let's go back to additional information number one. Additional information number one. Number one, you were told that Joshua Limited had non-capitalized lease of 10 million in each year for 2012 and 2013. We have non-capitalized lease. So that means you have to capitalize it. Eh? So that means you add the lease. And the lease was 10. This one was 10. So now that means the adjusted capital employed is 233, and this one is 260. Now let's get the IVA for 2013 and 2014. So in this case, we have said that you take the no part. So the no part for 2013, it's 56.8, and for 2014, it's 59.2. And then you deduct the return on capital employed. We already have the capital employed. For 2013 is 233 times, you already have the cost of capital. That's the WACC. Eh? For 2013, the cost of capital was 11.52. So this one will multiply by 11.52%. For 2014, the capital employed was 260. If you want to get the returns, the cost of capital in this case was 13%. So that means for 2013, you get 29.96, and also for 2014, you get that 5.4. So now this is how you can comment. Eh? Based on the using EVA for 2013 and 2014, since the two figures are positive, so now we can see that the economic performance of the wealth of the company, that one is good. Because this is 29, that means it's positive. Also that 5 is 0.4. But to be specific, we can see that 2014, they are doing greater than 2013. And I think we have also answered even part 2 of the question. Part 2, comment on the performance of Joshua Limited. Now we can see that Joshua Limited is performing well because its economic value added, both here, they are positive. But you can also emphasize that 2014, they are doing great because they are having higher than 29. Eh? So, any question now? Philip?
Yes, I'm okay. I'm okay.
Ask the question.
I'm okay.
You're okay now, eh? Jagona? Any question? Jogona? David?
Yes, sir.
Do you have a question?
Yes, I have a question, sir.
Yeah, ask the question.
You can only,
Sorry?
we can only compare 2 years, or there can be more. It's on,
No.
the IVA is calculated for 2 years.
No, it's not a must. Eh?
It's not a must.
Yeah, in this case, you're only given for 2013 and 2014. Eh? Okay, in most cases,
So
you usually do it per annum. But in this case, you are given for 2 years so that you can be able to compare.
Okay.
Yeah.
Well understood.
Good. So, Abdallah?
Yes, John Mark.
Do you have a question?
No, thank you.
Okay, so now let me emphasize on something. I can emphasize on something. So in this case, can we go back to note number, let's go back to note number what? Note number 5. Let's go back to note number 5. And note number 5, you are told that, yeah, The pre-tax accounting profit is obtained after deducting the economic depreciation of the company non-current asset. This is also the depreciation used for tax purposes. So this is what I mean. Assuming you are already given the amount of depreciation, you could have added back. You add back the depreciation, and then you raise economic depreciation. I repeat again. You add back the normal depreciation, which is just a provision, and then you less the capital allowances. But in this case, you are told that it was already deducted, and which was also the one used for economic depreciation was the same. So that means they cancel out. So can we go back also to note number what? Yeah, note number 8. Note number 8. Additional information number 8. The economic depreciation was 30 million in year 2013 and 35 million in year 2014. So now, here we are supposed to add back 30 and then you raise that. You see they are setting off. So in this case, assuming you are given depreciation as a different figure, you add back them and then you deduct the capital allowance for the economic depreciation. So, and that's all about the economic value added. Maybe you have realized more questions, so you can ask a question. Angelica? Angelica?
Yeah, I was asking.
Ask
Yes.
the question.
Mark. Yeah, I was asking.
Yeah.
Yeah, I didn't get how you arrived at the 250 on the capital employed
Or capital
for
employed,
year
the 250,
2014.
this one, Okay, so now do this.
Yeah, the 250, I didn't.
Okay, do this.
Yes.
Go back to the question to the balance sheet. Statement of financial position. Are you there?
Yeah, I'm there.
Okay, can you see the total asset or the finance by total capital? For 2013,
Total assets.
For 2013?
2013 is a statement of financial position.
Yeah.
Financed by.
Yeah, financed by the total.
Yeah, it's 250.
Yeah, and that's what you say
I've
that.
gotten it.
Yeah, for 2013 becomes for 2014, Sasa?
Yeah. Yeah.
Any other question?
Thank you.
Florence?
Yes, John Mark.
Yes, that's the question.
So it's not a question, but I'm thinking.
Yeah.
You got the wrong figures for profit after tax.
Sorry?
I think we wrote the wrong figures for profit after tax. Profit after tax.
Let me see.
Because it's supposed to be 55, not 45.
Yeah, it's 44 and 55, sorry. This 55, sorry. Yeah, the profit after tax, yeah, this 55, I can see you observant, Thank you. Is that? Can This one, This one. This one. 60? So this one will be 69.2, Good. David?
Yes, John Mark. Yes, John Mark.
Yeah?
I was raising the same observation.
Okay. The figure was wrong.
The additions.
Okay.
Yeah. Then again, I have a question.
Yeah, ask the question.
Hello.
Yeah.
For the fingers which are when you add or you less, you get a 0.
Yeah.
Are you supposed to show the examiner in the workings, or you just leave them?
It's not a must, It's not a must, but in case you show there is no penalization, you can't be penalized.
Yeah.
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 Hoping there is no other question. So I think now we can proceed. So now let's look at another method. We look at another method. So the second method of valuation, number one was economic value added. Number two is what we call the enterprise value, EV. Now, for the enterprise value, so in this case, for the enterprise value, it's just simply, how do you determine the worth of the company? So in this case, you just get the present value of those who have the rightful claim to the company. That means to get the enterprise value, you just get, we have said that, you just get the market value of those who have the claim from the company. That means that ordinary share capital, the preference share capital, the long-term loans, or the long-term debentures. So in this case, to get the economic value, you just get the market value of ordinary shares. You add also, you have said you take the market value of the preference share. Also, you have to get the market value of long-term. For the long-term debts. So, and then you can also deduct cash and cash equivalent. Cash and cash equivalent. So that's simply how you get the economic value added. This is one of the simplest methods because for the value of the when you're getting the market value of the ordinary share capital. So assuming the company has 1 million issued ordinary share, you just multiply by the market price. Assuming it's 10, then you come here to the market value of the preference share. So in that case, this one mostly does not change. So you take the number of the shares, let's call it X, you multiply by the market price. Assuming the market price is 12, you multiply by 12. For the market value of long-term debts, now assuming you're having a debenture does not change regardless of what. This is what we call a fixed covenant. That one does not change. And then you raise the cash and the cash equivalent. So one of the advantages of enterprise value, this method is easier to compute and therefore it's easier to understand. Then another advantage is that also for the enterprise value, it uses the cash flow, not the profits. And that's all about the enterprise value. This one has no computation. So now let's go to another method, which is very important. Number they are called, which is free cash flows. Free cash flow. What do we think are the free cash flows? So now let's go back to Philip. Let's go. Fatima. Fatima.
Yes.
Fatima.
Hello.
Hello.
Yes. Philip. Fatima.
Hello.
What do you think are the free cash flow? Free cash flows, What do you think is the free cash flows? Free cash flows,
Hello. Hello. Hello.
Philip.
Hello.
So now let's just continue.
Yes.
So what do you think is that is free cash flow?
Free cash flow.
Yeah.
I think that the cash flow is available for distribution to the shareholders.
Correct. Now that's what we call the free cash flow. So now free cash flow, they are just cash flow or the amount of cash available to distribute to the ordinary shareholders. So that means for you to get the free cash flows, you just check the sales, you deduct all the expenses, and then first of all, you have to add back provision. Remember, we have said that when you are getting the free the cash flows, when you're using this, you only deal with the cash flows, not the profit. So you take the sales of the revenue, you deduct the expenses, and then you add back all the provisions. So you add back the provisions. Also, you can deduct any capital expenditure. Capital expenditure. So that means in this case, you take the sales, you have paid all the expenses, including the tax. This one, the tax is included. Then you add back the provision. Provisions such as, let's say, depreciation, amortization, impairment, and then the amount remaining, that's what you call the profit after tax. Now you can have what you call the capital expenditure. That means if you, in case you have any investment, you take the investment. Now, what remains is what you distribute to the ordinary shareholders. Now, that's what you call the free cash flows. Now, when you're determining the value of the company, when you're determining the value of the company. So in this case, you take the risk-free cash flow, then you compute or you get you discount the cash flow. For example, year one, you discounted the year one, year two, year three, year four, then you get the total computed cash flows. So now let's do the first illustration. Do the first illustration. From there, take out your handout. From the handout. We have to post it there. So now let's do that question. We do that question now. And you're told that JM operate a gym in Subukia and another one in Shamahoho. The following are transactions expected in the next 2 years. So we have the period year one and year two. We have the sales. We have the administration expenses. We have the interest expenses. Then we have the capital expenditure. Additional information. The corporate tax rate is 40% and the cost of capital is 12%. Required. Using the free cash flows, determine the minimum amount JM Limited would be willing to sell the gym. So can I go through the question again? Go through on your own. Australia. Now we can go back. So now let's continue. Let's continue. So now let's be here. Let's be here. Let's be here. So in this case, we want to get the free cash flows. So we are given the sales for each year. For year one, the sales, we expect 50,000. For year two, we expect 80,000. Then you are given the administrative expenses. So year one is 10,000. You deduct that one. The other one, first of all, you raise the expenses of 20,000. Also, you have the interest expense. So you raise 5,000 and also you raise 4,000. So kindly don't confuse. For the risk cash free cash flow, we have said that you deduct all the expenses except the provisions. When you are doing the IVA, when you're getting NOPAT, that's when we said we don't deduct the interest because interest is not an operating expense. It's a financing expense. But in this case, we are deducting all the expenses. Then from there, you can get the profit before tax. 50 minus 15, that means you get that 5,000. 80 minus 24, that one you get 56. Then we deduct the tax. We are told that the corporate tax rate is 40%. So in this case, you raise 40%. 40% of that 5,000 is how much? I think this one is 14,000. And also 40% of 56,000, you get 22,400. So now we can get the profit after tax. And the profit after tax, in this case, you get 21,000. 56 minus 22,400, you get 33,600. Now, those are the profit after tax. Now, let's go back to the question. We are given the capital expenditure. Capital expenditure. So for the capital expenditure, in year one, the capital is 8,000, and in year two, it's 7,000. So now let's be here. So you raise the capital expenditure. Now, here you need to invest 8,000. Here you need to invest an amount of 7,000. Now, what remains is the amount which can now be distributed to the ordinary shareholder. So in this case, now that's what we call the free cash flows. So in this case, you get 18,000, and the other one, you get 26,600. After we get the free cash flow, we have said that in this case, you have now to discount. How do you discount? By getting present value interest factor. This one is not an annuity. This is 18, this is 26. So that means you discount them as separate. We are told that the cost of capital is 12%. 12% year end. So use the formula 1 plus R, that's 0.12 raised to power negative n. In the first year, you get how much? So for the first year, 12% at year one, you'll get 0.8929, and 12% in year two, you'll get 0.7972. So now we can get the present values. You take 18,000, you multiply by the discounting factor. In that case, you get 11,608. 26,600, you multiply by the discounting factor, you get 21,205. So the minimum acceptable amount you'll take, so for the minimum acceptable amount that JM will need to sell the gym, you'll take the present value of the cash flow for year one, it's 11,608. You add the present value of the cash flow for the second year, which is 21,205. In that case, we'll get that 2,813. And that was the question. The question was, using the free cash flow, determine the minimum amount JM Limited is willing to sell the gym. This is the minimum you can say that. That means, in short, this is the value of the company now. Any question? Bianca. Do you have a question? Jogona?
Yes.
Do you have a question there?
So far, none.
Uh-huh. Kate, Ndida?
Yes.
Any question?
A comment.
Yeah.
We got a wrong value for the free cash flows in year one.
Sorry?
We got a wrong value.
For year one,
For free cash flow year one.
Okay, actually, yeah. 21 minus 8, yeah.
18, not 18.
That 5 minus that one, you get, that's 20, minus 8, inakuja ngapi? No, it's 21 minus 8. This one is 13, right?
Yeah.
Yeah, correct. I think this one is okay, eh? Yeah, this one is okay. Thank you. If you have a comment, kindly raise your hand before I go to the next question. Let me give you 2 minutes. You can go through the question. Go through the question. So now let's continue. Let's do another question. Sorry? Okay. Arima?
Hi.
Yeah?
I was asking, what's the difference between cash flow to the firm and cash flow to the equity holders?
Sorry?
Cash flow, the difference between cash flow to the firm
The cash flow to the firm?
And cash flow to the equity holders.
Actually, they're almost the same. The only difference is that the cash flow to the shareholders, mostly is more of what we call the retained earnings for the company, or the amount which is to be paid to the shareholders as a dividend. Are you getting? But to the firm, now to the firm in this case, you have to take both the present value of the equity and the long-term debt. That's the difference. To the equity, you take the cash flow for the equity as well as for the long-term debt. But to the ordinary shareholders, you only take for the ordinary shareholders only. In that case, you don't take into consideration the present the cash flow for the debts, long-term debts. And in this case, you don't consider the short-term debt like payables or the accruals. So you only take the long-term.
So does that mean cash flow to equity holders, you'll have to less the interest? Less interest.
Plus the interest?
Yeah.
No. So in this case, you have to, it depends which method are you using. When you want to get the value of the cash flow, when using the IVA, in that case, you have to less the interest.
Okay.
But, you not deduct the interest, I mean, that one is not operating. You see, for IVA, you only consider the operating only, the operating cash flow.
Okay.
Yeah, because we have operating cash flows, we have investing cash flows, and also we have what we call financing cash flow.
Okay.
In that case, when you're using the method of IVA, in that case, you don't deduct the interest. But when you're using the other methods, you have to deduct the interest.
Okay, okay.
Yeah. So
thank you.
Another question? Okay, good. Now let's do another question. May 2019, question 5B. May 2019, question 5B. Open that question. May 2019, question 5B. For those who don't have the question, there is the question to be posted there. The question is to be posted there. Good. I'm hoping now you are all there. So we are doing May 2019 question 5B. We are told that Excel Limited is considering acquiring Best Limited, a firm in the same industry, in order to consolidate its market share. Best Limited has been less profitable, so it has paid an average of only 20% in taxes during the last several years. In addition, it has used retail debt, having a debt ratio of 25%. If the acquisition would be implemented, Excel Limited could operate Best Limited as a separate wholly owned subsidiary. That means 100%. This will increase the Excel Limited gearing ratio to 40%. So that means the weight of the debt will be 40%. So that means the proportion of the equity will be 60%. So the following is the forecasted financial data for Best Limited over the next 5 years. So remember, you have told that the Excel Limited could operate Best Limited as a whole owned subsidiary. This will increase Excel Limited gearing ratio to 40. So that means when you are determining the WACC, which is weight of equity, cost of equity, weight of the debt, cost of the debt, 1 minus T, we already have the weight of the debt. Because we are told that the gearing ratio will increase to 40%, the weight of the debt will be 40%. That means the weight of the equity will be 0.6. So the following is forecasted financial data for Best Limited over the next 5 years. So we have year 1 up to year 5. We are given the net sales in millions. We have the operating cost, selling and distribution expenses, administrative expenses, acceptable investment project. Those are the capital expenditure. Additional information. Number 1, the risk-free rate of return is 8% and debt is considered to be risk-free. The expected return on market portfolio is 13%. The firm leverage equity beta after acquisition is estimated to be 0.8. Now, up to that point, the information given there, you can forget the cost of equity. Cost of equity you use the CAPM formula, where the return of the security, in this case, you take risk-free rate plus expected return of the market minus the risk-free rate, you multiply by the beta. And in this case, we are given the risk-free rate. Let's go back to note number 1. The risk-free rate of return is 8%, and debt is considered to be risk-free. So that means the risk-free rate is 8%. You add the expected return of the market, note number 2. Note number 2, the expected return on market portfolio is 13%. So you take 13%, then you raise the risk-free rate, which is 8, and then you multiply by the beta. That's note number 3. The firm leverage equity beta after acquisition is estimated at 0.8. So that means the cost of equity, it will be 12%. So that means to get the cost of capital, in this case for the capital, you take for the debt and for the equity, you take the weight of equity, which is 0.6, times the cost of equity, of which we have gotten is 12, plus weight of the debt, which is 0.4, you multiply by the cost of the debt. You already given the cost of the debt. How much is the cost of the debt? You are given the cost of the debt there, which was 8%. Let's go back to note number 1. Number 1, you already told. The risk-free rate of return is 8% and is considered to be risk-free. So that one is 8%, and then 1 minus t, 0.3. I'll get the WACC, it's 9.44%. Now let's go back to the question. Note number 4. Note number 4. Note number 4. You're told that after 5 years, the net cash flow of Best Limited shall increase at a constant rate of 6% per annum in perpetuity. The corporate tax rate is 30%. The firm gross profit margin is 40%. If the gross profit margin is 40%, that means the cost of capital is 60%. Best Limited incurs fixed financing cost of 2 million per annum. The firm equity share and board are currently trading at par. Required. Determine the maximum price payable to acquire Best Limited using the discounted free cash flow. So how much should we pay to acquire Best Limited? So now let's be here. Let's be here. So first of all, we need to get the free cash flows. Free cash flow, and how do you determine the free cash flows? So we have year 1, year 2, year 3, year 4, year 5. So we have the sales, and for the sales, year 1, it's 50, 60, we have 75, 70, and 65. Then you deduct the cost of sales so that you can get the gross profit. And you're told that, that's courtesy of note number 6. Note number 6, we are told that the firm gross profit margin is 40%. So to get the gross profit, you just take 40% of the sales times 50. Like in the first year, you get this is 20. If you take 40% of 60, this one will get 24. This one will be 30, 28, and 26. Then after we get the gross profit, now we raise the expenses. So in that case, we are given the operating cost. Operating cost. We are given the operating cost. And the operating cost for the first year is 5. The second year is 10. We have 15, and also we have 12. Also, we have selling and admin expenses. We have selling and admin cost. The first one year is 10. Also, we have 10. We have 8. We have 9, and we have 11. Then also you are given the interest cost. The interest cost each year is 2. After you pay the interest, now you can get the profit before tax. So in this case, you take 20, you raise all the expenses. So this one will be 3, This one will be 2, 5, 2, 1. Those are the profit before tax. Now let's deduct the tax. And we are told that the tax is 30%, so that you can get profit after tax. So in this case, you take 30% of 3, which is 0.9, around be 0.6, 1.5, 0.6, and 0.3. From there now we can get the profit after tax. This one will be 2.1, 1.4, 3.5, 1.4, and 0.7. Again, we pay the tax. Now you can invest. So you are given there the acceptable investment project cost. For year 1, the amount we can invest is 0.5. The second year, we can invest 0.7. The third year, we invest 1.6, 1.2, and lastly, we can invest 0.2. After invest, now that's how you get what we call the free cash flows. So in this case, you'll get 1.6. This one will be 0.7, 1.9, 0.2, and 0.5. Now, after you get the free cash flows, now you can discount present value interest factor. In this case, you already have the cost of capital, which was 9.44%. So it's present value interest factor, 9.44% year N. So 9.44 is not from the table. So in this case, use the formula. That's 1 plus R raised to power negative N. So and you get that for the first year, you get it 0.9137, 0.8349, 0.7629, 0.6971, and 0.637. From there now we can get the present values. 1.6, 1.46, 0.58, 1.45, 0.14, 0.32. So now let's get the total present value. So you add the total, year 1, year 2, year 3, year 4, year 5, and you get the total cash flow or the total present value. So in this case, you'll get to be an amount of 3.95. That's the total present value. So I want us to go back to the question. That's not all. We go back to the question. Go back to the question. Note number 4. Let's go back to note number 4. Note number 4. Note number 4, you are told that after 5 years, the net cash flow of Best Limited shall increase at a constant rate of 6% per annum in perpetuity. So after the 5th year, so this cash flow, and we had this was the free cash flow for year 5. We are told from year 5 up to perpetuity, the cash flows. I'm saying that at the end of year 5, the cash flow at the end of year 5 is expected to increase at a constant rate. We are given a constant rate of, that's 6%. Yeah, constant rate of 6% per annum to perpetuity. So how do we get the present value of cash flow to infinity? So in this case, present value of cash flows during constant growth period. This is the formula I use. So in this case, you take the annuity, 1 plus R, cost of equity minus the growth rate. And then since you are getting the present value, so in that case, you have to take present value interest factor, the discounting rate, and the period. Or this formula is the same, the one used to get the PO, the value of the share, where you take DO, 1 plus the growth rate, let me call it growth rate, plus the growth rate over KE minus growth rate. It's the same. So in this case, you take the annuity 1, and this one after year 5. The cash flow after year 5 will grow at a rate of 6%. So in this case, our A, or annuity in this case, will be 0.5. Then expected to grow at a constant rate of 6%. That means our growth rate will be 0.06. You divide by cost of equity or the cost of capital. So in this case, you use the cost of capital, or you can use the rate. So in this case, our case was 9.44. So you take 0.0944, you raise the growth rate, which is 0.06. With that case, you get the value. And then, since in this case, we want the present value, you have to discount. So you discount using present value interest factor. And in this case, since you are taking from year 5 to grow up to perpetuity, they have not specified the year. So you take to have year 5. So it will be 9.44%. You use the discounting for the last year, which is 5 years. So that means, in that case, I have the figures here. Which is 15.41, your discount using 0.6370. That's what you do. You'll get 9.81. So now that means the total value, you'll take, you already have the total present value from year 1 up to year 5, which was 3.95. Also, we have the present value during the constant growth period, which is 9.81. So in that case, the total value of the company to be paid is 13.76. I repeat again, whenever you are told that the cash flow are expected to grow at a constant rate up to perpetuity, this is the formula you use. You take the annuity for the last period, 1 plus the growth rate over the rate minus the growth rate, and then to get the present value, you have to discount. Yeah, any question there? Let me give you some. Victor.
Yes, hello, John Mark.
Yes.
I'm asking, what if this business raise income other than sales?
Sorry?
For example, issuing of bonds.
Sorry?
I'm asking.
Yeah.
What if this business raised income in other ways other than sales? Like, for example, issuing of bonds.
Issue of bond?
Yeah, for example.
You see the issue of bond? If you use the bond, you mean the cost of issuing the bond or what?
Okay, I'm asking.
Can you reframe the question?
Sales is revenue.
Yeah.
Now, what if the business is raising income other than sales?
They have other incomes. So
yeah.
Also you have to add, it's part of cash flows.
Okay, so we
assuming you have dividend income, you have investment income, all of them, other incidental income, commission, they are part of inflows.
Okay.
Yeah, you could have added.
Okay, thank you.
Yeah. Good. So let me give you 2 minutes to go through it. Also, this one I have to send. I'll send all the materials. For those who are at KC, I'll send them. For the others, they have to get from Somia, Kenya. I've already sent there. I will send a link. You can get the other notes. So kindly go through it. So we do a last question. So we call it a day. So, have you realized any comment or question? So now, I want you to get this concept on how to discount after the growth period. So for example, there was a question that was stated on May 2019. So the same sitting, May 2019, question 2B. May 2019, question 2B. Open that question. So we are told that ABC Limited is a company listed on the local security exchange. The company is foreseeing a growth rate of 12% per annum in the next 2 years. The growth rate is likely to be 10% per annum for the third and the fourth year. Then it will stabilize at 8% per annum in perpetuity. The latest dividend to be paid was 1.5 per share. The required rate of return is 16%. Required. The intrinsic value of the share. Intrinsic value of the share. So now, in this case, we are not getting the value of the firm. We are not getting the value of the firm. We are getting the value of specific security. And in this case, which was, I think, was preference shares. So in this case, how do we get the intrinsic value, which is the same as getting the value of the company? But in this case, we are getting the value of just one security. So to get the intrinsic value, you just take the present value of dividend. If it was for the whole company, in this case, you could have used the present value of cash flows. And then present value of dividend during non-constant period, non-constant period. Then you add present value of dividend during constant period. Like in this case, this is how you have used this one. And you have said that when you're using this present value of dividend during the constant period, you just take DO 1 plus G. Then you take KE, or the cost of equity, or the cost of capital, minus the growth rate, and then you get the present value interest factor. So you want to get the intrinsic value of one security. So now let's go back to the question. We go back to the question. You're told that the company is foreseeing a growth rate of 12% per annum in the next 2 years. So we have year 1, year 2, year 3, year 4. We are given the growth rate of 12% per annum in the next 2 years, and growth rate is likely to be 10% per annum for the third and fourth year. So the first one is 12%, the other one is 10%. Then it will stabilize at 8% per annum. Now let's be here. So how do we get the dividends? So in this case, we'll be getting DO 1 plus the growth rate. We are told that the last dividend to be paid was 1.5. So we are told that year 1 and year 2, it will grow at the rate of 12%. Then from year 3 to year 4, it will grow at the rate of 10%, after which it will stabilize at the rate of 8% to perpetuity. So how do we get the dividend from year 1 to year 4? So we are told that the dividend, which was previously paid, was 1.5. So we'll take 1.5, and then you expect it to grow at the rate of 12% for the first 2 years. So we take 1 plus 0.12. In that case, you'll get 1.68. Then year 2, 1.68. Then it grows with another 12%. It's 1 plus 0.12. In that case, you'll get 1.88. From year 3 to year 4, the growth rate would go down to 10%. So you'll take 1.88, 1 plus 10%, 0.1. In that case, you'll get 2.07. And then you take 2.07 to grow at another 10%, 1 plus 0.1. In that case, you'll get 2.28. Now, those are the value of the dividends. Then from there, we need to get the present value. How do we get the present value? To get the present value, you have to discount. Now you discount present value interest factor. You are given the required rate of return 16%, 16% year end. So now let's discount that. So to get in year one, 16% in year one is 0.8621, 0.7432, 0.6407, and 0.5523. Now you can get the present values. So you take 1.68, that's the dividend. You discount, you multiply by 0.8621. That one you multiply, you get 1.448. The other one you get 1.397, 1.3262, and 1.259. And then you get the total, which is 5.43. Now that's the total present value during non-constant period. That's for during non-constant period. Now let's get the present value of dividend during constant period. Present value during constant period. Remember, we are told that after year 4, the growth rate will stabilize at 8% per annum to perpetuity. So in this case, you take DO 1 plus the growth rate, you divide by the cost of capital minus the growth rate, and then you discount. And in this case, when you are discounting, you discount using the last year, which was year 4, and the discounting rate for year 4. So it will be present value interest factor 16% in year 4. If it was for 5 years, you could have discounted using the 5th year. So you take DO. So in this case, the DO. So now let's be here. So the dividend, the last dividend paid was in year 4, which was 2.28. So this will be your DO. It is 2.28. Then you expect it to grow at a constant rate of 8%. That will mean it 1 plus 0.08. You divide by the cost of equity of the required rate of return, which is 16%. So you take 0.16 minus the growth rate, and the growth rate is 8%, 0.08. What you get there, then you will discount 16% for year 4. You use this one. That's 16% for year 4. It will be 0.5523. And it's not an annuity. Don't use the annuity. Just use this for the single amount. So and in that case, you'll get 17. So to get the intrinsic value denoted by PO, we have said that you take the present value during non-constant period, which was 5.43. You add the present value of dividend during the constant period. And during the constant period, we have gotten it's 17. You add 17. So and in that case, you get 22.43. That's the value of that security. So 2 minutes, go through that question.